Across many industries, insurance pricing continues to face pressure. This is largely driven by rising repair and replacement costs, economic inflation, workforce challenges, and larger legal verdicts, which are all adding strain to traditional insurance models. At the same time, many of the highest performing organizations are rethinking how they manage risk to better control both costs and exposure. To understand why these changes matter and how they impact the traditional market, consider what insurance truly represents: a shared pool of risk. Imagine this bucket represents the standard insurance market. 1/3 of the companies are green balls and represent best-in-class performers. They have strong controls, disciplined processes, and consistently better results. 1/3 are yellow balls and represent average performers. They perform well overall, but have room to improve. And 1/3 are red balls, which represent the below-average performers. These companies drive a disproportionate share of losses, often because they lack clear policies, procedures, and meaningful safety standards. When these companies are pulled together, the math works. Overall losses average around 40%, which the standard market is built to handle. Over time, a shift begins. The strongest performers, or the green balls, start to leave the standard market and form new, more selective pools. Often those pools take the form of a captive, where risk is shared only among peers with similar performance and commitment. As these top performers exit, the risk profile of the standard market changes. Companies that were once considered average are now pushed into the top tier, not because they improved, but because the benchmark shifted. With fewer top performers in the pool, the average loss per company increases. Insurance companies reprice segments that bring the most volatility, or exit them altogether, leaving fewer options for those that need coverage. Even well-run companies are asked to carry more of the burden, simply because of who remains in the pool. Meanwhile, in the captive pool, the story is different. Risk is shared among companies with similar standards and performance. Over time, insurance can shift from a pure expense to retained value, turning a cost into a strategic advantage. If you're already operating at a best-in-class level, joining a pool built around that same standard may make sense. Explore whether a captive strategy is right for you with the help of the Baldwin Group.